To rise for the ICAI motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते अमृतमुच्यते अस्मिन् लोकः शतः सर्वे तदूनात्यधिकश्चन एतद्वैता 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 एतद्वैता.
Thank you. Now I would like to invite our chairperson CA Revati S. Raghunath ma'am to kindly deliver the welcome address and begin the session.
A very warm good morning to everyone. It's very heartening to see so many of our colleagues here on a Saturday morning, especially when the weather is very pleasant and you want to stay tucked in at home or just relax in the office. But it shows the seriousness with which this topic is viewed by all our members. So I want to thank and first welcome CAP Venkatesan sir and Charan Teja, Mr. Charan Teja from RBI. When we have been planning a session in FEMA for a very long time, and when I asked sir, we normally do at least once in 6 months we do cover every topic, and when I asked Venkatesan sir, shall we do this? We'll do a full day program. And he said, come, let's go to RBI. And that's how we have Mr. Charan here, the AGM of Foreign Exchange Department, who is actually, I think, the face of the department. He goes to all, exports promotion councils, the trade bodies, and he is actually very, I would say, reachable, and he clarifies all doubts about the trade regulations and or anything and everything to do with the foreign exchange department. And in this age of cross-border transactions where the borders are blurred, I think that whether we actually have a robust practice in foreign exchange or exporters, importers among our client base, I think we all need to have at least a working knowledge of all these acts and provisions, and be able to give a little bit of advisory to our clients, because even if you're doing a stat audit or you're doing an internal audit, these are all the areas where we actually may miss out something. And with so many regulators breathing over our necks, like our own institute, NEFRA, and now if you have all these transactions, cross-border transactions, of course RBI is also going to be breathing over our shoulders. And I thought none other than the horse's mouth to come and tell us what is it that the regulator is expecting out of us and how we are supposed to go about it. And when I just asked a few members, many of them from industry have come to update their knowledge, and others are of course come to actually understand the act and what RBI expects from us. So I should say Thank you very much, Venkatesan sir and Charan Teja sir, for actually accepting our invite and coming here to share your knowledge. I'm sure that Mr. Charan is going to throw a lot of light on what the regulator is expecting from us. I always feel that, we should never fear the regulators, because we have so many breathing down our neck, and sometimes it becomes overwhelming for us. Who's going to send what notice? This is something which all of us actually expect. Every day you open a mail or you get any registered post, you think, okay, somebody has got some issue with us. But I always feel that regulators, okay, you issue notices, but that is only if you think we have crossed some boundary. We need to interact with the regulators and have them on the same page, or we should be on the same page as them, so that we understand what is it that they are expecting. Because ultimately, as chartered accountants, we are considered to be partners in nation building. And I always tell all the government departments, sir, okay, fine, you think we are partners, but both of us are almost on the same side. Even though we may be sitting across the table, we both are working only for the government, but only thing, the caps which we don are slightly different. So don't always view the chartered accountants as someone who's out to, outsmart you. No, we are not. We may look like we are outsmarting you, but no, we are working for the government, we are working for the department, and we are ensuring that our clients are complying with everything. Don't paint us all with some brush which the media has actually used. 99.5% of all chartered accountants are extremely compliant and take their duties and responsibilities as partners in nation building very, very seriously. So with these words, I don't want to take up too much of time. I would just like to give a brief introduction of both the speakers. CA Venkatesan is a very senior chartered accountant, and he has been in practice for more than 48 years, and he is specializing in FEMA. Of course, earlier it was FERA, and over the past 30 years he has been specializing, and he's also rendering consultancy and services to foreign and Indian clients, including multinationals, especially as a consultant to the Indo-German Chamber of Commerce for about 15 years. The World Bank engaged him as a consultant to carry out professional assignments in connection with some of its projects abroad. And he's also written a book, External Commercial Borrowings, a Practitioner's Guide, which has been published by ICAI. And he has been delivering FEMA lectures at various fora of ICAI and also Society of Auditors, Society of Auditors, MMA, CA Study Circle, etc. And in fact, he gives recommendations and suggestions to the FEMA regulations to RBI, who reach out to him for the benefit of the stakeholders in general and for the entities whom the CA represents in particular. And his connect is available here. I'm sure it will be available in the PPT, and anyone wants to reach out to him, we will be glad to provide the connects of both Mr. Teja as well as CA Venkatesan. And the heavyweight from RBI, Mr. Charan Teja, has given 3 lines as introduction. So I would say that it carries a lot of weight. He is currently heading the trade section in the Forex department of RBI, and previous roles in RBI is government banking and currency management, like we say in Tamil, no, Karachi Kudichirkar, adnalna he's not able to distill it over here. So thank you very much, Mr. Charan, for actually accepting our invite, and thank you, Sir Venkatesan sir, for enabling this entire program. He curated all the topics and our visit to RBI, where they were extremely welcoming, and they said immediately they accepted to come and help us in this session. And thanks everyone for actually joining us. It is your participation which actually motivates us to give topics in niche areas where the practice is booming, but still many of us don't know where exactly we can actually utilize all our professional knowledge and marry the two with the other regulators. Thank you very much.
Thank you, ma'am. So I would also like to request our chairperson Revati S. Raghunathan to graciously present the memento to our speakers CAP Venkatesan and Mr. Charan Teja as a mark of our esteem, respect and appreciation. Thank you, ma'am.
Okay. Here's my first topic. It's an actual case study. What happened in this case was an Indian company entered into an equity swap agreement with a US company, whereby the Indian company was to issue its shares to the US company against issue of shares of the US company to the Indian company. This is essentially what the equity swap was meant to be. So the agreement was entered into and the valuation was done by a merchant banker. All that was complied with, everything was done. When it was reported to the bank, it got stuck. Now we'll follow this story. This was the sum and substance of the agreement. As in the case of merchanting trade transaction, I am just calling it ODI leg and FDI leg. It is not there in the NDA rules. Just for ease of understanding and remembering the transaction, I just labeled it like that. The FDI leg of the swap is the issue of shares by the Indian company to the foreign company. FDI always involves issue of shares of an Indian company to a person resident outside India, a PROI. So the issue of shares by the Indian company is the FDI leg of the swap. And the issue of a foreign security is always under ODI. It does not come under the NDA rules. It comes under the Overseas Investment Rules 2022. Any issue of shares of a foreign entity to an Indian entity, it's an outbound investment. So the outbound investment is the ODI leg and the inbound investment is the FDI leg of the swap transaction. So there is a difference in the reporting procedure. For the FDI leg, you have to file an FCGPR return at the RBI's firms portal, and for the ODI leg, you have to physically file a form FC with the designated AD Bank branch. So for the FCGPR, you will get rejection comments online at the firm's portal, and for the FC, you will get rejection comments across the table from the AD Bank, whatever the objections may be. Now, the FEMA issue which arose was based on the definition of equity instrument in the NDA rules. The crucial portion of this definition, which is relevant for the present case, is issued by an Indian company. Section 2K says equity instrument means equity instrument issued by an Indian company. It does not embrace any equity issue by any foreign entity. This is where the difficulty arose. That is equity shares, convertible debentures, preference shares, share warrants, anything. all these come under equity instruments, but the catch was issued by an Indian company. I'll talk about the amendment separately. It came in 2024, where RBI has tried to find a partial solution to the problem which arose in this case and such cases. I will explain that amendment later. For now, let us understand the original provision which was there before August of 2024, when RBI brought in the amendment. This was the original shape of para 1D1 of the first schedule to the NDA rules. This permitted issue of shares against swap of equity instruments. Please notice the expression equity instruments occur in two places in this definition. First, where it says an Indian company may issue equity instruments. Then again it says against swap of equity instruments. The bank took the view that in both places equity instruments mean the same thing, that is equity instrument as defined in Rule 2K. Bank was sticking to this definition and said in both places equity instruments mean the same thing as defined in Rule 2K. The implication of the stand taken by bank is that while the Indian company issues its shares to the foreign company as part of the swap agreement, the foreign company also has to issue the shares of an Indian company, because equity instrument has been defined as issued by an Indian company in Rule 2K. This was the stand that the bank took. My argument was equity instrument means two different things in these two places. In the first instance where it occurs, where it says an Indian company may issue equity instrument, it means shares issued by an Indian company, obviously. So that equity instrument comes under the definition in Rule 2K. But not subpara 1, swap of equity instruments. There, equity instrument must be interpreted in the generic sense and not as defined in Rule 2K, because the foreign company cannot issue the shares of an Indian company. Foreign company can only issue its own shares as part of the swap. This was the stand that I took. This was the rejection comment. Hence, PROA also must issue shares of an Indian company. This is the rejection comment that I got when I filed the FCGPR on the firm's portal. This was the crux of the problems, ladies and gentlemen. This was the conundrum that had to be resolved. So to resolve this issue, I put forward the following arguments. How can outbound investments be covered under NDA rules? They are covered only under the overseas investment rules of 2022 or under FEMA 120 before that. But this NDA rules can only cover inbound investments of various kinds. FDI, FPI, NRA, OCA investments, etc. and immovable property, which has also been defined as non-debt instrument now. Under the NDA rules, the definition of non-debt instrument now includes immovable property also. So all these are covered, and all these are inbound investments. So the next question is, how can a person resident outside India issue an Indian company's shares under the swap agreement? He can only issue his own shares, I argued. Not only that, theoretically, even assuming that he can issue an Indian company's shares, for example, the foreign company has an Indian subsidiary whose shares he is willing to issue in exchange for the shares issued by the Indian company under the swap agreement, then it's no longer an FDI, no longer an ODI. It's a domestic transaction. If an Indian company issues shares to another Indian company against Indian company's shares, it is simply a domestic transaction. There is neither FDI nor ODI involved in it. So it loses its very character as a foreign exchange transaction. That is the other reason why we cannot interpret equity instrument to mean only Indian companies' shares in both the contexts in which it occurs in the definition under Rule 1D1 of Schedule 1.
In swapping, they use the word issue or mere swap of equity instruments.
Sir?
While talking about swap, they use the word issue of shares or they simply say swap of instruments.
No, you have to issue the shares to the other company, no? Or transfer your existing shares. Those are mechanical. Those are mechanics.
It's possible, no? Subsidiary company shares they can sell. In turn, in consideration, they can Indian company, another Indian company can issue shares. Is it possible?
No, suppose they sell their Indian subsidiaries shares to an Indian company, where is the FEMA angle in this?
No, but without receiving money, Indian company will be issuing shares.
Indian company is issuing shares, sir, there is no problem there, it is the FDI leg. There is no dispute. Indian company issuing its own shares constitutes the FDI leg of this swap transaction. The difficulty only arises when the bank insists that the foreign company must also issue an Indian company's shares. If the foreign company issues an Indian company's share, the ODI leg of the transaction will get converted into a domestic transaction. So this is the solution that I offered. The first time the equity instrument occurs in 1D1, you can say it's share of an Indian company, there is no contradiction there. Indian company issues its shares and that constitutes the FDI leg of the swap. When it comes to the second instance where it occurs, 2K should not be applied. Rule 2K, which says equity instrument means share issued by Indian company, that definition should not be applied. You must understand it in the generic sense of equity instrument being applied by issued by the foreign company, which is its own shares, not an Indian company's shares. So if you understand it in that sense, that will complete the ODI leg of the swap. Indian company gives its shares to the foreign company gives its shares to the Indian company. Then the swap gets completed, both the FDI leg and the ODI leg. So that will enable the transaction to go through. But if you put forward an impossible condition that the foreign company should give Indian company shares, then the transaction cannot happen as a swap. This was one more argument that I gave. Rule 2K, the rule 2 itself, when it starts, it says, in these rules, unless the context otherwise requires. I said this context otherwise requires. This context requires that you interpret equity instruments in a different way and not as given in Rule 2K. Only then it will be a harmonious interpretation which will enable the swap transaction to go through.
Here, has the word swap been defined anywhere to say that it has to be a swap of a foreign instrument only and not a domestic instrument?
It's a swap of equity instrument, sir. you can issue equity shares. Indian company may issue equity shares against swap of equity instrument. That's all it says. I will go back to that. Against swap of equity instruments.
So the question is, it only say swap of equity instruments.
Yes.
It doesn't say the foreign company has to necessarily issue shares. If they have an investment in Indian subsidiary, that shares can be transferred to another Indian company. That Indian company can issue shares to. Is it possible?
It is possible, sir, but then it won't be a swap of FDI ODI. It won't be an FDI ODI swap.
But
Are they using the word?
The second leg will cease to be a cross-border transaction. The intention of the parties is Indian company issues its shares to the US company. The valuation has been made of shares of both the companies. Based on that valuation, certain number of shares is agreed upon. And the US company issues its shares to the Indian company as the ODI leg of the swap transaction. Indian company issues its own shares as the FDI leg of the swap transaction. This is what the transaction is in its essence. The only thing that comes in the way is the definition in Rule 2K, which says equity instrument means only equity instrument issued by Indian company. That narrow definition puts us in a bind. So then, since Rule 2 itself says unless the context otherwise requires, my context otherwise requires. In my context, you should not call it shares of an Indian company. You should call it shares of a foreign company. It only says equity instrument. So, swap of equity instruments. This is how it was before September 24. I will tell you the development after August 24. In August 24, RBI brought in an amendment, a rejection comment. Okay, we have come up to this, sorry. Fourth Amendment Rules. NDA Fourth Amendment Rules 2024. Has substituted para 1D1 with a new para D. What it has done is, those three subparas of clause D which you saw continue to be there. Swap of equity instrument, and then pre-incorporation expenses, and against capital expenditure. Those three options continue to be there. They added a fourth subclause saying that equity instruments may also be issued by swap of equity capital of a foreign company. That amendment has been brought in. If this had been there when I did the filing, this problem would not have arisen. But that still leaves the first subclause unresolved, where it says you can issue equity instrument against swap of equity instrument. That continues to be there. Where there RBI has not clarified, equity instrument means one thing the first time it occurs, and it means another thing the second time it occurs. That clarification has not been given by RBI, but this is a sort of patch-up job or band-aid, you can say. It solves the problem which I faced in that case, because the bank interpreted equity instruments under Rule 2K in both the cases, for both FDI leg and ODI leg. In that case, the bank said, I will have to seek prior approval of RBI, because the definition of Rule 2K permits only issue of Indian company shares. Therefore, if I want to get my swap agreement approved in the manner in which it had been made, whereby Indian company was going to issue Indian company shares and foreign company was going to issue foreign company shares, we would have to go for specific approval of RBI. It's a stand that the bank took. But I gave all these arguments and RBI finally agreed no prior approval is required. This transaction can go through on the basis of the reasoning that I gave, fortunately for my client. So it went through. But subsequently RBI has made this patch-up job without clarifying that equity instrument means two things in those two places.
So to extend this, the foreign company should also issue fresh shares, or it can exchange its holding in some other foreign company shares to Indian company, and Indian company can issue shares. Both should issue.
No, if it's a foreign security that they are giving as part of this swap, it should be acceptable because it only says swap of equity instrument and it says of a foreign company, not necessarily the foreign company which is being allotted your shares of the Indian company. So if the swap agreement says so, it could be done. In this case, the swap agreement says I give you my shares, you give me your shares. But the situation that you are envisaging could arise where the foreign company says instead of my shares, I will give some other foreign company shares. But he cannot say I will give Indian company shares. Then it won't be a swap.
What is under the same ratio, earlier to this amendment, Indian company can issue shares to a foreign company against its sale of shares of an Indian company, shares held in Indian company to foreign. Is it possible?
No, see, if an Indian company share is exchanged for an Indian company share, it loses the character of ODA, no? That leg, ODA leg.
No, but the corresponding amendment there in OIA rules also.
No, corresponding amendment says that you can issue, Indian company can issue equity instruments to a foreign company against the share capital of a foreign company. That they have made it clear now. So this will cover my case. But still the first clause, that conundrum they have not resolved. They have not clarified that the equity instrument actually means two different things in those two different contexts. They have not clarified. Without clarifying that, they have added a subclause which says you can do a swap with a foreign company's shares. So that will take care of my swap agreement or cases like this. Next one.
What was your resource when your FCGPR got rejected? And what was your next resource? You immediately represented the RBI what was happening?
No, the thing is, sir, we live in faceless times. The facelessness is good and bad. When it comes to income tax, the facelessness is very good. Because many years ago, you had to chase every refund, big or small. And then the client had to forego 5% or 10% to get back his own hard-earned money. So those days are gone. Now you file online and the refund lands in your bank account in 1 or 2 months. So that's a huge relief for clients and for us. So there the faceless situation is working to the advantage of the stakeholders. But the faceless situation may not always be conducive, may not always be helpful, because the firm's portal throws up n number of objections. You have no way of explaining to the firm's portal what I just explained. If you can sit across the table and explain it to an intelligent human being, it's much easier than to make the system understand your arguments that equity instruments should not be interpreted this way. How can firm's portal make a judgment? Then the bank will forward it to RBI and RBI will take a call on that. That is how it was resolved in my case. Whereas FC, you do the filing directly with the bank. Because there were delays and all that. When you filed the FCGPR, you got an objection saying, why have you not filed FC? So once I filed FC, it said, where is the FCGPR? So this tamasha was going on for many months. That is another matter. Those are logistical issues. But in matter of interpretation of the regulations, this is the crux of the issue, and it is resolved this way. Can we move on to the next topic, ladies and gentlemen? This is an interesting case of RBI versus RBI. What happened was, some months ago, there was a news item in the Economic Times saying that RBI moves to fine companies for taking foreign guarantees. RBI directed a couple of banks to impose fines on certain companies because they had taken foreign guarantees, which is prohibited under the FEM Guarantees Regulations 2000. So the companies argued rightly that under ECB regulations we are allowed to take such guarantees. So where is the violation? This is how it panned out. This was the original guarantees regulations. It is in the process of being replaced by new guarantees regulations right now. It is in the draft stage. RBI has published a draft for public comment, and we will have a new guarantees regulation soon. But till date, this is the guarantees regulations number 8 of 3rd of May 2000. The FEMA became an act in 1999, but it was launched, the FEMA regime was launched to replace the FERA regime on the 3rd of May 2000, when a whole bunch of regulations were notified by RBI. And I always remain grateful to RBI for notifying these on the 3rd of May rather than on the 2nd of May. Because if I had been poring over the new FEMA regulations on my wedding anniversary, I would have had trouble with my home ministry. So instead of 2nd of May, they notified everything on the 3rd of May 2000. This is one of the original notifications of RBI when FEMA was brought into effect. Regulation 3A of original guarantees regulations prohibits foreign guarantees. Sorry, ladies and gentlemen, just give me a moment. I am locating regulation 3A for you. Yeah. Regulation 3A, restriction on obtaining overseas guarantee. No corporate registered under the Companies Act 1956 shall avail domestic rupee denominated structured obligations by obtaining credit enhancement in the form of guarantee by international banks, international financial institutions or joint venture partners except to the prior approval of the Reserve Bank. So the structured obligation meaning taking a foreign guarantee for a domestic liability was prohibited under Regulation 3A of the Guarantees Regulations. There is a proviso which permitted such guarantees if you are issuing bonds or debentures, but not if you are taking loans. Did not extend to loans, but only to bonds or debentures issued by Indian companies, guarantees could be obtained. That relaxation was there as a proviso to Regulation 3A. Now we come to the ECB regulations. The whole argument of the companies which were told they were liable for fines was that under the ECB regulations we are permitted to take foreign guarantees. So that is why we have taken into compliance with the ECB regulations. We did not know that would constitute a violation of the guarantees regulations. Something that is compliant with one regulation should not constitute a violation of another regulation, but that's what happened. This Master Direction number 5 is based on the borrowing and lending regulations of 2018. This is what governs these three: external commercial borrowings, trade credits and structured obligations. It is part 3 that is of interest to us here. Structured obligations. Structured obligations mean transactions between domestic entities, a transaction which is guaranteed by a foreign entity. So there is a principal debtor and a creditor in India, and there is a foreign guarantor. The thing is, in a structured obligation, until the principal debtor defaults, there is no FEMA implication at all, because there is no outflow of foreign exchange, no inflow of foreign exchange. The transaction is between a principal debtor in India and a creditor in India. As long as he is honoring the contract, performing according to the contract, it's a rupee transaction through and through. Only when it defaults the foreign guarantor, when the guarantee is invoked, that is when it begins to have FEMA implications. Until default, there is no FEMA application. This is the sum and substance. Once a guarantee is invoked, the foreign guarantor has to make a foreign inward remittance to honor his guarantee, and then he will immediately have a claim against the principal debtor in India for reimbursement for having honored the guarantee. Therefore, he will call upon the principal debtor in India to remit that amount to him as a foreign outward remittance. RBI is saying the principal debtor in India in such a case does not require prior permission of RBI for the foreign outward remittance. He can go ahead and make the remittance. It is allowed under the automatic route. This provision continues to be there even to this day.
Sir?
Comes to guarantee, before issue of guarantee, like you have to file form ECB and all, get a unique identity number and all, or it is nothing, is no filing is there.
No, there is no FEMA implication until default occurs.
So it comes
This is a transaction between two Indian entities which is guaranteed by a foreign entity.
Correct.
which comes alive only when the principal debtor defaults.
So,
Until then, it's a piece of paper.
correct. But that for that piece of paper, the Indian company need not file any forms, any.
Nothing. The structured obligations part of
Okay.
the master direction on ECB trade credits and structured obligations places no reporting obligation or any other obligation on the parties until default occurs.
So, when the obligation is not met, the foreign person pays the money. At that time, whether it is a ECB form ECB and all to be filed, or that case also nothing is required to be filed.
There is no form ECB required to be filed because the Indian company is given general permission to reimburse the guarantor for having met the obligation.
Reimbursement is second leg, sir.
Yes.
First leg, he gives the money. It's a constructive payment to Indian company.
Yeah, it's a payment to the Indian creditor.
No.
It's a payment to the
it's a
Indian
payment
creditor
to the
in honor of the guarantee.
No, it's a payment to the creditor, but it's a constructive payment to the Indian company.
Yeah, that is why he claims reimbursement from the Indian principal debtor.
So no, what I'm asking is, sir, at this stage also no form ECB to be filed, nothing is required.
No.
Okay, but can this be easily circumvented? Because instead of taking a ECB loan, I will just take a guarantee from the foreign person, and I will intentionally not pay. He will pay it. Is it? I'm just thinking aloud.
It is possible.
We can
This-
avoid all the ECB, even monthly ECB 2, all those things.
Yeah, it can be done. The way it stands right now, under structured obligations, part 3 of the master direction, you can go ahead and do this. Two Indian companies can have an agreement saying that a foreign entity guarantees the transaction, and then if there is a default, foreign company has to pay, has to make a foreign inward remittance, and the Indian principal debtor has general permission to reimburse the guarantor for the payment made.
So repayment takes some time. What is the average maturity period? What is the cap on interest?
No, those things have not been specified.
Can I pay interest?
Well, that maybe you may have to go to RBI for a specific direction on that, because there is nothing specifically mentioned here. If you go according to the master direction and what it permits you to do, you can do it and get away with it. But if you want to refine it further and further, then you will have to go to RBI for prior approval. If you want to rely on the letter of the master direction, you should confine yourself to what it actually says. But if you want to make further interpretations and take further advantage, then it's better to go to RBI for specific directions. Otherwise, you may fall foul of RBI.
But in the process, the Indian company becomes a defaulter.
Indian
Defaulter
company
to the-
does become a defaulter.
So,
That is when the guarantee is invoked. Indian company becomes a defaulter to the creditor in India, and the guarantee is invoked against a foreign guarantor, and he has to pay the Indian creditor because there is a guarantee, and then he immediately gets a right of reimbursement against the principal debtor in India.
no,
All this is under general permission.
what I'm saying is, just to achieve this, you may have to sacrifice the Indian company's credibility with the bankers.
Yeah, that may happen. I mean, if you are doing it as a designed way of avoiding ECB compliances, then it will of course affect your credibility. But if it's a genuine case where a transaction has happened and default has happened for genuine reasons, then it will stand scrutiny. Otherwise, of course, your credibility will take a hit for the future. This is the stated purpose of the new FEMA 8R, which is in the draft stage. 14th of August, they have put out a draft for public comment, and they are yet to issue the FEMA 8R, the new avatar of the guarantees regulations, is yet to be issued. But the thing to note is, they have dropped Regulation 3A. In the new draft, they have dropped the Regulation 3A which prohibited foreign guarantees. So the prohibition on foreign guarantees has been done away with. That is all that the new regulation says. If you have foreign guarantees, report it. That's all. No prior permission required, no prohibition. This is a recent development on the ECB side. In October, they have come out with new draft regulations on ECB. That is also out for public comment throughout October. But the new ECB regulations are yet to be issued. New borrowing and lending regulations, strictly speaking, that will cover ECB, trade credits and structured obligations. They have brought in a new Schedule 1 to the borrowing and lending regulations. Schedule 1 deals with ECB, Schedule 2 with trade credits, and Part 3 of Master Direction deals with structured obligations. Schedule 3 will deal with external commercial lending and all that. So Schedule 1 is for external commercial borrowing. That entire schedule has been replaced by a new Schedule 1. So many changes have happened. Like for example, your present limit for ECB is 750 million per financial year, isn't it? That has been raised to 1 billion or 300% of your net worth as per the latest audited balance sheet, whichever is higher. So 2-3 other changes have been made. They have simplified the definition of eligible borrower, recognized lender. Recognized lender, previously they had said he should not be in an FATF country. Even that they have done away with. I don't know why. Previously, recognized lender, they had said that you cannot borrow from a lender who is in an FATF notified country. Even that they have done away with. So these are some of the changes made in the new draft ECB regulations. That is not directly on the issue we are discussing. Just for information, I am saying that new ECB regulations are coming. This is what we are interested in. No change has been made to the structured obligations part of the master direction. Even as of yesterday, as I downloaded the master direction on ECB trade credits and structured obligations, this continues to be there. Structured obligations continue to be permitted. So if it is still permitted under structured obligations, where was the question of fining those companies for availing foreign guarantee? Just because your regulation 3A of guarantees regulations contained a prohibition which contradicted a permission which was given under structured obligations of the ECB regulations. This fine should not have been imposed when the structured obligations provision continued to be there. All those provisions on structured obligation continue to be there. Another incidental interesting question on this new ECB draft regulation is something that I have been talking about at seminars. This is an old problem which continues to persist. Even in the new draft regulations, RBI says that in the event of default by an ECB borrower, the property mortgaged by him for the ECB shall be sold only to a person resident in India. That restriction continues to be there. My question is it okay if this person resident in India is a non-citizen? Is it acceptable to RBI? Because person resident in India, as per the definition in section 2V of FEMA, could be a non-citizen, could be an agent or office of a person resident outside India. He is also deemed to be resident in India. And a non-citizen who has come for employment or business, he is resident in India, but he is a non-citizen. Is it okay for RBI if non-citizen buys immobile properties in India, when you are not permitting non-resident Indians to buy agricultural land or plantation or farmhouse? Basically, the policy philosophy is that land in India should not pass into the hands of non-Indians. That is the thrust of the policy, essentially. And even in the case of non-resident Indians, you are not permitting them to buy agricultural land or plantation or farmhouse in India. When that is the case, how can you allow immobile properties which are mortgaged for ECB to pass into the hands of non-citizens because a sale had to be made to realize the ECB for the ECB lender abroad? That could not be the intent. It needs to be clarified that it can be sold only to a person resident in India who is a citizen of India. That would square with RBI's overall philosophy of being protective about immobile property in India when it comes to non-citizens. So that needs to be clarified, but it's still not there. Even in the latest draft ECB regulations, this has not been tweaked. Some years ago, when RBI invited suggestions from me for amendments in the FEMA regulations, this was one of the points I had raised. Do not allow ECB default properties to pass into the hands of non-citizens. If that is not your intent, then make it clear. Don't say it can be transferred to anyone resident in India. Say it can be transferred only to a person resident in India who is a citizen of India. That's it, ladies and gentlemen. I am done, unless you have questions.
Sir, I have one question on guarantees. Guarantees. Let us say there is an Indian company which has got a contract with a customer in India. It doesn't have the necessary resources to, let us say, open a advance bank guarantee or a performance bank guarantee. Therefore, the foreign parent of the Indian company opens a bank guarantee in favor of the customer in India. This it does by opening a guarantee on an Indian bank, let us say some IndusInd Bank or some other bank. And based on that guarantee, the Indian bank would open a guarantee in favor of the customer. In the process, the Indian subsidiary company has no role in the guarantee, although the contract for supply is between the Indian company and the Indian customer. Is this permitted?
No, I don't think so. Because the new guarantee regulations draft clearly says that no entity regulated by RBI shall give a guarantee. That would include all Indian banks and all non-banking financial companies in India. All entities regulated by RBI. Entities regulated by RBI. Under ECB also, you can offer a security, you can give corporate guarantee or personal guarantee for an ECB, but an entity regulated by RBI cannot issue a guarantee.
No, you mean the authorized dealer in India receives a bank guarantee from a foreign banker.
Right. The authorized dealer in India is entity regulated by RBI, no?
Right. So can it not give a guarantee in favor of another Indian company, which is happening all the time?
Yeah, that may be so, but under the guarantees regulations, under the ECB regulations, RBI does not want Indian banks to give any guarantee. Only corporate guarantee or personal guarantee is permitted. For ECB's, guarantee is permitted, personal guarantee or corporate guarantee. But bank guarantee, if you want to give, RBI does not permit under the ECB regulations.
No, I'm not on ECB regulations. I'm simply on a guarantee. Let us say I'm an Indian company. I've got a contract from another company. Okay, that particular company wants an advance bank guarantee from me so that it can release the advance. I don't have the necessary resources. I request my foreign parent to ensure that the guarantee is given to the customer. The foreign company approaches his banker. His banker opens a guarantee in favor of an authorized dealer in India, and the authorized dealer, based on that guarantee, opens a guarantee in favor of the customer. It's a trade transaction. There is no borrowing.
Under the new guarantee regulations, it may become possible because regulation 3A has been abolished. Regulation 3A, which was there in the original guarantees regulations, has been done away with. That is the one which prohibited foreign guarantees. The provision which prohibited foreign guarantee was Regulation 3A. In the new draft guarantees regulation, that has been dropped. But it's only in the draft stage. What shape it is going to take when it becomes a regulation, we do not know. We will have to wait and watch.
So as of now, this transaction is not possible.
As of now, this transaction is not possible because Regulation 3A is still sitting there in guarantees regulations. The point is that RBI should not be penalizing on the basis of Regulation 3A when you still have the structured obligations under ECB regulations. That is a contradiction. That is the essence of what we are discussing is, when ECB regulations permit structured obligations, why are you bringing Regulation 3A to penalize me for taking a foreign guarantee? Structured obligations clearly envisage foreign guarantee. That is what structured obligations are all about. It's a transaction between two Indian entities and it is guaranteed by a foreign entity. There is no FEMA implication until default happens. When default happens, there is a foreign inward remittance required, and then for reimbursement there will have to be a foreign outward remittance, which is also permitted. All this is still part of the law as far as the ECB goes. It's not in relation to ECB, sir. So let me emphasize, this structured obligation chapter is in the same master direction as ECB and trade credit. But structured obligation is not under ECB. They have just included that as an additional chapter in the master direction on ECB trade credits and structured obligations. But it's not an ECB transaction, structured obligation, because it's a domestic transaction. Basic underlying transaction is domestic. Therefore, it's not an ECB. There's no foreign borrowing involved at that stage. The foreign inward remittance will occur if default occurs. That is permitted.
Sir?
Yes, sir.
Can you throw some light on the APR, sir? Where the host country doesn't have mandatory audits. The confusion of audited accounts, attaching the audited accounts or unaudited accounts along with the APR. Different banks says different things. Where host country, there is audit is not compulsory. So it is not audited. While filing the APR, it should be filed compulsorily audited balance sheet. Since it is not audited there, some branches say it can be audited by the Indian CA. Can you throw some light, any idea about?
Sir, this depends on the extent of control that the Indian investor has on the overseas entity. Where he has control, he will be responsible to file audited accounts even if the host country does not insist on audit. Where he does not have control, then he doesn't have to do that. He can file unaudited balance sheet.
So audited means I have to get it audited from host country auditors, or?
Not necessarily. It can be audited by a CA in India also.
Yeah, that is where it poses a lot of concern and trouble for the Indian auditor. Considering your audit process and guidance of the institute, it is very difficult for us to sign it. I am raising this as an auditor concern, not from the client point of view. Because
let him get it audited by a chartered accountant abroad in the host country.
okay.
Then this issue will not arise. Any other questions, ladies and gentlemen?
Right back of input payables
Ah.
are
Import payables.
Specifically, this is from group companies. This is from holding company.
Okay.
So
On what ground are you writing back?
So subsidiary company could not able to make payment. So holding company agreed. So they have given NOC.
Holding company has agreed.
Yes.
There should be no problem doing that, because if you are saying that I do not want to remit foreign exchange, RBI is always happy. Only if you want to remit foreign exchange, you have to make sure that you are on the right side of RBI. If you are saying that I was supposed to pay this amount in dollars, but I am not going to pay it because they are not insisting on it, and you are going to write back the liability, RBI should have no problem with that. They will not insist, why are you not paying your holding company? They will not say.
But should they compulsorily, if it lapses 1 year or 3 years lapses, depends on current or non-current, expires, should they comply with the ECB? Because will not automatically become an ECB as per the trade credit?
Which one, sir?
Sir, capital, I import capital item,
Okay.
capital account transaction or whatever, some loan. So they have a ceiling of 1 year or 3 years. If you don't pay it within that 1 year or 2 year, 3 year, as per the, it automatically becomes an ECB. So I'm just asking, even if they have to get a waiver, should they compulsorily apply to the RBA or ECB, then only do it, or?
No, this import of capital equipment may come under trade credits as long as it is within 3 years.
Correct.
And it will become an ECB if it goes beyond 3 years under normal circumstances. But whereas for a manufacturing company, it's even allowed to take an ECB for 1 year if it is up to 50 million. So that exception is there for manufacturing companies. Other companies can take ECB only for a minimum average maturity period of 3 years. Up to that point, it is considered a trade credit. Whether it's for equipment or for goods, it is considered a trade credit. Beyond 3 years, if it goes, it becomes an ECB.
No, my question is, suppose the liability he is saying is say for more than 3 years.
No, he was talking about a trading liability, I think.
More than 3 years.
Is it a trading liability?
No.
It's a trading liability.
You know what will happen, sir? Will it not become a ECB violation actually? Since it processed 3 years, will it not become a ECB violation? Trade credit, the directive will be changed to ECB.
No, it will not become an ECB violation because you have not taken a loan in the first place. A trade liability has arisen. They have sent you goods for which you have not made payment. And now the holding company is waiving that payment. That does not involve any ECB violation. It still remains a trading transaction, it's a current account transaction. So ECB regulations do not come into play. You can report it to RBI through your AD bank, saying that this liability has been extinguished by mutual agreement. Are we done?
So for incorporating a subsidiary company, so holding company has sent some amount around 30 lakhs to a proposed director. So they sent the amount directly to the proposed director account, and the director started spending that amount for the incorporation and other expenses. So now the Indian company wants to remit that amount to holding company. I think now it's more than a year. So is there any implications or any violations, or whether they can do it because they did not receive in their bank account?
The foreign investors send the money to the local director's account for
Yes, sir.
incorporation of the company.
Correct. For incorporation, running primarily, running the business of the company, they send that amount.
He wants to be allotted shares against the.
No. So the holding company has sent that amount to the director account.
Yeah, does the holding company want to be allotted shares against that amount?
No, they want the money back. The Indian company is ready to pay that amount back.
Huh.
The Indian company has the money, they done the business, they have the money now. They want to remit the amount to holding company.
There is a provision into the current account transaction rules for reimbursing your holding company for such expenses up to a certain limit. I don't remember the limit now, but there is a provision for doing it in the current account transaction rules.
Thank you, sir.
Okay, shall we wind up, ladies and gentlemen? Thank you very much.